Hello, everyone, and welcome to the latest LPL Market Signals podcast. Jeff Buchbinder here, your host, again this week with my friend and colleague, Jeffrey Roach. How are you today, sir?
Hello, hello. Happy to be with you.
I am happy to be online because I was not on Friday morning because I was a victim of the biggest IT outage in the history of the world. So I cannot tell you all how happy I am to be with you because there was certainly a point where I didn't think I'd be working for a little while, although that's good and bad, right?
And I'm happy to be back in the office. I was out with a regional workshop or presentation, and thankfully I was not impacted by the flight problems that I think are still going on. So happy that that was the case.
So you dodged trouble. I did not. So hopefully most of you listening were not more impacted than I was. But at any rate, it's Monday afternoon, July 22nd, 2024, as we're recording this. The agenda here you can see on the screen for those of you watching. We're going to start with of course, as we always do, with a recap of what the markets did last week. The biggest story being the rotation from tech into small caps. Next, of course, the biggest news of the week was Biden dropping out of the race. So we'll talk about what that means for the Trump trades. We talked a little bit about the Trump trade last week, go into a little bit more depth there. And actually, the odds of a Trump victory have dropped just a bit here since we've gotten the switch from Biden to presumably Kamala Harris. Next, I'm glad Jeff's here for this one. There's a relationship between the economy and the election, of course. There has been for as long as I've been paying attention to elections. So we've got a couple of studies that can give us some insight into what we might get in November. And then finally, of course, we'll preview the week ahead, and there's some big data on tap. The GDP report for Q2 and the Fed's preferred inflation measure, the core PCE. So let's start with a recap. I mentioned the rotation was the big story. You can see here in just this weekly look how dramatic it was. The S&P down about 2%. That was the biggest decline, weekly decline since April. NASDAQ, even worse, down about 3.5%. Of course, that's the rotation out of tech. But then you see the small caps were a beneficiary of at least some of those proceeds. So we got almost a 2% gain in the Russell 2000. It's really hard to say if that rotation continues. We'll talk a little bit about small caps as a Trump trade here in a moment. But, big tech earnings are coming up. That may support large caps. And as Jeff, you'll get into in a bit, there's some economic factors that maybe suggest that small caps have some headwinds, and this might not just be a straight line up the rest of the year for the Russell too. So more on that in a moment. You see the tech sell-off even more dramatically when you look at the sectors. The tech sector was down almost 5, or down a little over 5 on the week, and then of course you've got some tech-oriented big caps in comm services and consumer discretionary. So those sectors were down 3. We at LPL Research have been kind of splitting the difference between growth and value for just this reason. We didn't want to get too out over our skis on growth, for once the rotation came, and sure enough, it came. So you see that in the styles, down 4 on the U.S. growth index, up almost 1 last week on the value index. And then turning to overseas, I think the way to sum it up is that you've got dispersion all over the place. But in general, a stock market that prices in Trump as the favorite is unlikely to see much outperformance broadly in international markets. So, we saw some weakness in Japan. They're exposed to the global semiconductor sell-off here recently. We got some weakness in Hong Kong. We've got political uncertainty still in France, so we got some weakness there. Germany, it's really a tough trade environment for international. Anything to add there, Jeff?
Well, it's just a reminder, for our podcast listeners, the reason why we stay on this slide for a little bit longer than normal is, there's a lot of good information here, as we talk about a little bit of the rotation from last week. It's important to remember, well, what's the bigger picture, the 3-month year-to-date numbers, obviously the 1-year numbers. So that's why you see a lot of numbers on this page, but we're just trying to be comprehensive in the way we present it. Yes, a turnaround. It certainly had that uptick in claims that comes out 8:30 Eastern time on Thursdays, Thursday morning. And last Thursday, there was a little bit of a disappointment in terms of the rising number of initial folks asking for benefits. And then there's also been a steady rise in those that are what we call continuing claimants, those that are on not just for the first week, but second, third, fourth, continuing to collect unemployment insurance because they're looking, at least they're supposed to be, in order to collect and qualify for these benefits. They got to be looking for a job, but not finding one yet. So that uptick last week certainly was a little bit of a unsettling metric for the markets. That was part of some of that change in consumer sentiment last week, but very different when you look at longer term metrics here, Jeff. Another thing I'd like to highlight is we're looking at the top number here. The top part of the chart, top left is domestic markets, bottom right is internationals, and we've certainly been a little more heavy on the domestic side, and that's been beneficial given the headwinds, Jeff, as you highlighted earlier.
Yeah, still have that view, favor the US over international and emerging markets, for sure, for tactical investors. Turning to the bonds, bonds, commodities, and currencies. The Bloomberg Aggregate Bond Index was down a little bit last week. That ties to the so-called Trump trade because, Trump is perceived as being bullish for rates or bearish for bonds. Those are the same thing, of course. And so you got a little bit of a weakness there. But what's I thought was interesting is high yield was actually pretty good last week, even though the equity market was down and rates rose a little bit. Of course, high yield not as interest rate sensitive as the traditional treasuries, traditional corporate bonds. So that certainly helped. Energy started to do better. There's some energy lift in the high yield bond market. Turning to commodities, the crude oil, in the 80 to 81 range. Crude oil's actually entered into a weaker seasonal period now. We're past the best seasonal time for crude. And then China growth has weighed a little bit on that commodity. I guess what's tough here, maybe we'll bring up the dollar here, Jeff. Dollar didn't do anything last week, but of course the election is still several months away, and obviously we don't know who's going to win. It's not even 100% certain who's running, but it's fairly certain, but not 100%. This has certainly been the election season. If anything could happen, some people think that a potential Trump victory would be bullish for the dollar, but he and JD Vance have talked about a weaker dollar. Right? They want a weaker dollar. They want to compete better with international, other countries outside the U.S., of course, on trade. But if the policies are going to push up the dollar, it's really going to be hard for him to be a weak dollar president if he is elected. Thoughts on that?
Well, I think we know pretty solidly that there's this desire for rates, at least central bank target rates to go down, right? Pressure to cut. Remember what he did while he was in office.
Good point.
And so, if we know that there's that bias, that's certainly going to weigh a little bit on the dollar. And that's been kind of really the story so far in 2024. Fed saying, hey, we're going to be on this patient pause. And meanwhile, we see European Central Bank cutting. So that's explaining a lot of that divergence between dollar euro. And then, of course, same thing in terms of the yen as well. That dollars has been strong given the fact that Powell's been so consistent on wanting to keep target rates unchanged. At least now we're in a new environment. So perhaps I could see dollar weakness, maybe by the next, end of the year, as rates start to normalize a little bit and come down, as Fed can begin legitimately cutting some rates.
Yeah, we know Trump likes low rates, so that certainly is dollar negative. Here's the S&P. We said last week this might be a convenient place to pull back, and sure enough, that's what happened. And probably not over. The 200-day is still something like 500 points below where we are right now. That would be maybe a reasonable target to look at for a pullback or a correction. But we'd still have the 50-day moving average as support at 5409. So, that's about 100, maybe call it 130, 140 points down from where we're trading at the moment. So watch that for support. And then the rotation out of tech and into other names is kind of evident in the bottom panel here. The percentage of stocks in the S&P 500 with new 52-week highs is up to 15%. That's a pretty good reading, and certainly up from where we've been lately. So that said, let's turn now to, of course, the biggest news over the weekend, which is Biden dropping out. And, the question, I think, we're market folks. We're studying the economy. We're not political strategists. So, and most of you probably don't care about our opinion on who's going to win. But we will report the facts, which is what the, Predictit website, the so-called betting markets, is saying. And so Trump's odds of winning got to about 70. I think, yeah, right around 70% at the recent high after the failed assassination attempt, then have dipped back a little bit. So now this is a 61-39 kind of a race. So Trump's still the favorite, but some of the, bloom off the Trump trade rose, I would say, over the weekend and a little bit today, maybe is, in part because Trump's odds have fallen. Also, Harris is considered to be friendly to tech, maybe a little bit more friendly than Biden.
Well, it's interesting, Jeff, as you go back to that slide, you have the, if you're focusing on the Kamala line, you're like, oh, wow, things have really changed with that large spike. I think the better way to look at it is saying, okay, there was a decisive switch that happened at the debate, right? That infamous debate it certainly will go down in history. And then maybe just a little bit of normalization when we say, okay, Trump's not going to be, campaigning against the person that was his debate partner, but someone who's actually a little bit more, lively and able to, to engage a little bit better than his former debate partner. But at this point, you think these are pretty high odds where we're sitting today. But then again, as we like to say, anything can happen. It's only the middle of July. A lot can happen in the months ahead.
No doubt. No doubt. It's been a crazy few weeks, needless to say. So we'll operate under the assumption that Trump is the favorite at this point. But certainly Harris versus Biden. There are some differences. They're pretty minor, but some, and maybe the friendliness to tech is one difference. Mm-hmm. We'll see if that comes to pass. But anyway, so let's get into Trump trades. I think this is probably the one that's gotten the most attention, Jeff, just because we've had this rotation into small caps at the same time that people are assessing the Trump trade. So small caps have had a really nice run. In fact, the 7 days through last Tuesday, which I think was the 16th, was the biggest 7-day period of outperformance ever for the Russell 2000. That is saying something, because the Russell 2000 has been around for a long time. I think goes back to the late 1970s, if I'm not mistaken, or certainly goes back at least to the mid 80s. So we've had this nice breakout, really strong performance from small caps. The top panel just shows you the breakout. We're not quite to the 2021 highs for the index, but we're close. It's been a very long recovery to prior highs for the Russell 2. They say the bigger the base, the more room and space. That is a long base. So after we get that breakout to new all-time highs for the Russell 2, you might see the technicians jump in. Just like with the S&P, we've had a lot more 52-week highs in the small cap index. Um, this is actually the S&P version of small caps, not the Russell 2, but you'd see similar dynamics. And then on the bottom panel, you see the relative strength is sort of repairing the damage, right? So we're not quite at a breakout on this relative strength downtrend, but we're really, really close. And so I think when that happens, if it happens, you're going to see a lot of technicians recommending even more small cap exposure. So right now, research view at LPL is neutral. I mean, the technicals were terrible just a few, or not even a few months ago, a month ago. The technicals were terrible, but we were still neutral. We moved up to neutral about, I think it was March. And the reason we did that is because high quality small caps, like you get in the S&P 600, are cheap. And they had just been unloved for so long, we suspected that there would be a turn at some point. Obviously, timing hard to predict. So right now we think neutral is the place to be. And Jeff, the economy is probably the reason we're not more optimistic right now, I would say, in addition to the fact that we haven't gotten a relative strength breakout.
Yeah, you got a couple factors that have some competing forces going on. You have a weakening economy, not dramatic per se, but clearly weakening in terms of people's interest to spend, as we're coming into the middle part of this year. But on the other hand, you do have the chances for a weaker dollar and lower interest rates. Yeah, so you think, okay, well, in that sense, those things could help those smaller firms don't have quite the arsenal of cash as perhaps large cap firms do, most likely interested in tapping credit markets. And so if that remains, credit markets remain attractive for those coming in to borrow, that's certainly going to be a competing factor against some of that slowdown of small caps. I do want to remind, some of our listeners might, wonder, okay, why are we talking about Trump trades? Basically, what we're trying to get at is we're saying, okay, there's a potential for a change in administration. What parts of the markets could most likely feel and actually change because of that change in administration? So that's kind of the logic. And I think, Jeff, you did a great job as you're putting these slides together to say, okay, of the various ways in which you could try to trade and invest for a new administration, you'd break it down into our top three likely candidates that could be interesting to think about as you prepare for a new administration.
Yep, that's exactly right. Now we have the added variable of, a guaranteed change in the president of the United States.
For sure.
So, maybe that'll be for next week or maybe shortly after that, when we can talk about the differences between Harris policy and Biden policy and what that might mean for markets. But again, I think the first thing to think about is maybe a little bit less pressure on tech, although there was going to be pressure on big tech regardless. JD Vance certainly, talked about potentially breaking up big tech in the past. Trump has had a kind of love-hate relationship with some of the big techs in the past, certainly, particularly the social media giants. So, maybe the dynamic for tech hasn't changed too much with the switch from Biden to Harris, but that's one thing that's changed. I guess it's also important to think about small caps as, like you said, Jeff, play on rates. So it was the benign CPI reading we got a couple weeks back, and the the subsequent firming of the Fed rate cutting expectations that really started the small cap rally, and then the Trump trade kind of added to it because Trump is more pro U.S. than and more let's call it we'll call it a little bit of anti-international. I'm not talking about just he's not necessarily adversarial about all international economies. My point is, say if he increases tariffs, and he's talking about increasing them a lot, then that is more of a U.S. market, that pro-U.S. market than international market. And we all know that he's tough on China, and he'll probably be tougher on China than Harris would be, although she'd be tough on China too. That is certainly a huge part of the emerging markets index. So it'd be probably tough sledding for EM, although rate cuts and a potential weak dollar would be pro EM. So something, there's a lot there, but I think those are some things to think about. All right, so let's move on to energy. This requires some nuance, right? Because in 2016, drill baby drill, Trump was good for energy, but then the sector stunk, right? And why did the sector stink in 2016? Because there was too much production and prices went down. We may see that again. So how do you counteract that? If you want to play a possible Trump victory in energy, you probably want to look at energy services or energy equipment because they are tied to volumes of energy production, right? More so than tied to oil prices, right? Because oil prices might come down if Trump wins. So that's why where we're nuanced. Plus, of course, alternative energy would be, certainly a loser in a Republican administration. That almost goes without saying. So,
But remember the ripple effect.
Probably want to look at industries, Jeff.
Right. And then one of the things, when we talk about this and debate about it, there's ripple effects, right? So high production, energy prices go down, perhaps tough for the energy companies that are most connected. But then you think, okay, what about the secondary impacts? Lower cost for fuel on airplane, air carriers, et cetera. Perhaps a little bit better competition in that regard. So, yeah, there's second and third degree impacts to think about.
Yeah, the airlines need a break, so maybe they'll get it in the form of lower jet fuel prices, and of course that can be supportive of consumer spending. The Biden team, the White House, is going to do everything they can to get oil prices down, so Harris can run on a stronger economy, better consumer spending environment. So going back to this chart, so you see here, energy's had a nice little bounce. This is just the broad sector, S&P energy sector. So of course it has the majors, which are very price sensitive, but it also has services. So we've got a nice little bounce here, and we're maybe making a run at those recent highs. That's the top panel. The middle panel is relative strength, and we've stabilized, but certainly the moving averages and the trend are not yet positive. So energy has some sort of damage to repair, I guess. And then the last panel is percentage of stocks in the energy sector above the 200-day moving average. That has weakened a bit, but it's actually still pretty good. So believe it or not, energy is still kind of holding on to this uptrend. It's just an uptrend that's been losing steam, and certainly needs a catalyst, either higher energy prices, maybe better earnings. Should get some earnings growth out of energy this quarter. Maybe it's something in policy out of Washington, D.C. So let's go to the last one here, and this is banks. This one is interesting one too, Jeff, because there's a few things going on, right? I think the biggest thing is the yield curve, and if Trump does win, he's probably going to put pressure on the Fed to cut rates, and then you'll have potentially a steeper yield curve because Trump is a deficit spender. By the way, so is Biden and Harris, right? That's the way the wind is blowing. So if you have deficit spending, which means more deficit spending, which means higher interest rates, potentially, but Fed rate cuts, that's the recipe for a steeper yield curve. And then you also have deregulation, Jeff. What do you think?
Well, it's interesting. We did a piece several months ago now on regional banks, particularly when that was front center with Silicon Valley Bank, et cetera. I think it is a fair exercise for investors to go back to some of that work that we've done and to assess what's happening there. And if we can argue for that steepening yield curve, that's certainly going to help some of the exposures that these regional banks have. So that's a really interesting dynamic. So you're exactly right. You got the short end of the curve, meaning your 3 months, 6 month, all that 2 year, very sensitive to Fed policy. That goes down, and say your 10-year and on up are pushed up because of deficit spending. That normal, quote unquote, normal, as we say, normal shape of the yield curve, which is typically upward sloping, up and to the right, that would certainly be beneficial for some of those assets held on bank balance sheets, particularly those regional banks, smaller banks.
Yeah, we think we're largely past the regional bank troubles, but certainly a little bit of rate relief from here would help those that are still a little bit strained.
I like
Right.
that. Rate
We're not-
relief. I like that. You need to write on that one, Jeff. I like that.
Yeah. All right. I'll write on that one soon. By the way, if you want a copy of that regional bank piece, reach out to us and let us know. Yeah, I guess it's about the yield curve. It's about deregulation, and certainly you've seen the response, right? Look at this nice breakout on the regional bank index. We've broken through several areas of resistance. We have this nice kind of head and shoulders, bullish head and shoulders pattern, I guess. And then but the group is overbought. There's been so much excitement. And RSI 14 of 75 is hot. So, maybe they need to digest some of those gains here before making another run. Now here I'm going to hand it over to you, Jeff, for a discussion of the relationship between the economy and the election. So we've got two studies here that I think investors should keep in mind.
Yeah, it's interesting. So, going back to several decades ago, you think so it goes back to the 84 election. Basically just saying, hey, if you look at how the economy is and how people are feeling, so inflation rate plus unemployment rate, when you have such a low, a decreasing misery rate, meaning inflation's easing, unemployment's easing, that's the year-over-year change in the second from the left column there, and then you look over, you say, well, that's typically good for the incumbent. Now, what's a little bit confusing is we've had an unusual experience post-COVID and the reopenings where unemployment is extremely low, right? Challenges in the economy, certainly, right, as people are there's been so much retooling in the economy as people have moved around and both geographically and occupationally. So it's a little bit distorted, but raw numbers, certainly favorable for the incumbent party. And I think that's kind of another way of looking at it. Another angle is the next slide. And that is when you look at just the overall growth of the economy. So we had strange things happen, right? Economy shut down, reopening, growth rates in the high double digits. That's never happened before. And then kind of this modest decelerating in growth. So sub 2% growth in Q1, probably sub 2% growth in Q2. So we're kind of getting a little bit below trend. But, when there's no recession in the years leading up to the reelection, this is good again for those that have been managing, quote unquote, right? So there's your green on the left side, no recession, reelected. Yep, they got in. Good for the incumbent. Another angle for the previous slide. Again, this is a challenging time because you think, okay, well, no technical recession, a lot of consumer spending, right? A lot of people actually are getting paid more, even though we're paying more for stuff, we're getting paid more for what we do. And so hence, you're kind of offsetting it. There's no recession yet, and inflation is decelerating with a fairly low unemployment rate and tight labor market. Traditionally, that says, hey, good news, certainly bolsters the case for the incumbent. But again, 2024 coming out of the previous 2 years, you got to look a little bit deeper past the headlines, underneath the hood, if you will, to see what other factors might be driving voter sentiment.
Yeah, so Trump's a favorite. We've talked about what investment implications you might have from a Trump victory. But both of these studies suggest that the Dems have a shot, right? Actually, a good shot based on this study, right? We've had no recession in 2023 or 2024. And we're not going to get a recession before November, right? We can't guarantee anything, but if we do get a recession by the end of the year, people won't even know about it when they go to the ballot box. So this study suggests Democrats have a good shot. And then the misery index, we could still tick a little higher and be kind of in that neutral zone, right? Because
That's right. Because
unemployment
inflation.
might tick up, Jeff, even
Yeah,
if
yeah, exactly. Unemployment might tick up, but inflation is certainly going in the lower direction as it's decelerating.
100%.
So, yeah,
Right.
you're exactly right, Jeff. And this is why it's worth highlighting that this would be such an unusual dynamic and an unusual experience. Now, granted, the debate was pretty unusual. The dropout yesterday was unusual,
A
but
candidate nearly getting shot was unusual,
exactly. So,
needless to
when you
say.
when you think about what the Dems can do in the sense that, hey, look, we have low unemployment. If you want a job, you can get a job. People have the flexibility, to work where they want to work. Um, perhaps, that's going to be certainly their battle cry in order to solidify those risks. But I think it's important at this point. Um, you saw that graph earlier, Jeff, as you highlighted. It's kind of it's a 60-40 kind of dynamic right now.
Yep, that's right. So the misery index right now is right kind of on the line, pointing us to Democrats as a slight favorite, but every every cycle is a little different. This one is more different than certainly I think any of us have ever lived through. So we're not going to have any conviction on any outcome, frankly. But just know that the economic data points to maybe the Democrats having a better shot than the polls suggest. So let's transition to the preview of the week ahead. It's a big week, Jeff. I mean, we get 138 S&P 500 companies reporting results, including big names, Alphabet and Tesla tomorrow. Then we have GDP and the Fed's preferred inflation measure, the core PCE. So what should investors be thinking about this week?
Yeah, so most of it's going to be the latter half of the week. We're recording here on Monday, the 22nd, and it's a light day today. Tomorrow, fairly light. And that's really because the focus will be on Thursday and Friday because of those very, very important numbers, as I suggested. Second quarter growth, again, kind of sub 2% is expected, perhaps even a little bit softer than that. But that's after 1.4% growth Q1. So clearly, consumer slowing down. We're going to get a really detailed look on Friday morning on spending, everything from where consumers are spending on recreational services and financial services, durable goods, everything that under the sun here on the spending side. But more importantly, probably for markets, particularly bond markets, will be with embedded in that Friday morning report will be an inflation metric that's extremely important, more valuable, more comprehensive than the CPI metric. So, Jeff, as you highlighted, that turnaround in small caps and banks as well, due to the very benign CPI number, you get a benign deflator number. So we call it the PCE price index, how much we're deflating nominal, turning it into real figures. That could be very, very supportive for the markets and solidifies the fact that the Fed's meeting in September will be the first meeting where they start indeed cutting rates. And that's certainly going to be a fairly positive, I think, opportunity for markets as yields tick a little bit lower. So it's mostly Thursday and Friday. Those are the big ones.
All right, so maybe folks can hit the beach between now and then, unless, of course, you want to watch the earnings results stream in between now and Thursday's GDP. I also like the University of Michigan one-year inflation survey. Got that back down below 3, so we'll be watching that. And then I also think it's worth noting that the headlines on core PCE, Jeff, could be really positive because if the number hits expectations, I think that's a 3-month annualized number of below 2. Is that right?
Yeah, exactly. So we're getting very, very close to the comfort zone for the Fed. So we know from a number of Fed officials that when we talk about that 2% figure that everybody hears about in the news, it's a long run average, meaning many times inflation runs below 2%. Sometimes it's running a little bit above 2%, but kind of on a longer term average, if you're hitting that 2%, if you start dicing it in various increments, even when you think about where we are currently in the summertime here of 2024, you might say, hey, the Fed's getting even more comfortable that the rate of inflation, not the price levels, but the rate of inflation is getting a lot closer to their long run goal of 2%.
Yeah, and certainly the markets have responded. We have seen optimism about inflation reflected in not just small caps, but the rate environment as well. Certainly, just in general, supporting the equity markets. So if that trend, that disinflation trend continues, we could potentially see some gains ahead, even though we still think we're due for a pullback. So thanks for that, Jeff. Big week, a ton of earnings and two really, really important data points that we will all be watching closely. So with that, we'll go and stop. Thanks, everybody, for listening, as always, to the LPL Market Signals podcast. Thank you, Jeff, for joining. And we'll be back with you next week. Take care, everybody.